We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. I say this every time we start a show. You can always go to the website to learn more about Brian and the team. It's DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. And then I remind you, hey, under the heading on that website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education, there's 12 different things you can download, no cost to you, no obligation, no nothing. It's just there for your information, including Brian's book on retirement, The Decker Approach. You can download any or all of those 12 items on there, and it's really kind of what you want to learn more about when it comes to retirement in the financial world. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. Now, if you have questions, Brian's going to talk about a lot of things as he always does every week on this program. But if anything he talks about, you're like, man, I didn't know that. I'd like to know more about that. How does it affect me and my family? You can always call the team at Decker Retirement. There's no cost to you. It's 833-707-3030. We'll give you that number throughout the program. But it's 833-707-3030. It's always a complimentary call. All right, Brian, welcome. And you're going to get into Trump's tariffs. You're going to break down what exactly tariffs are going to China, what goes to Mexico, what goes to Canada, right?
Right. We're going to talk about tariffs because that is something that is very much front and center in people's discussions for their portfolio for 2025. So many investors are talking about the policies that will be enacted under the new administration. Definitely the most controversial economic approach has clearly been the tariffs, Mark, which keywords may be leveled against, you mentioned it, China, Canada, Mexico, the EU, or other blocs and nations.
So are you going to break down whether Canada becomes the 51st state or we buy Greenland, or you're not going to get it that far?
Not going to even touch that. Mark, how about you?
Yeah, no. I do like Canada, though. Canada's really nice. I like Canada. Yeah.
I like Canada.
Yeah.
So what we will do is just take some quotes of people that are very much into the know, Treasury secretaries, Commerce secretaries, and see what they're saying about Trump tariffs. So first of all, Treasury Secretary Scott Bessent, he said this, Mark. He said, the truth is that tariffs have a long and storied history as both a revenue-raising tool and a way of protecting strategically important industries in the United States. President-elect Trump has added a third leg to the stool and using tariffs as a negotiating tool with our trading partners. Our size gives us market power and the ability to dictate terms. Other countries need us more than we need them. We have but to use that power. So, Mark, I just want to add parenthetically that I heard Trump say that everything coming out of Canada, which we just talked about, can be easily produced.
What was it? Lumber, dairy, and something else, I think he said.
Yeah, I heard that interview. And that'd be devastating for Canada if we just shut down trade. But knowing Trump, I mean, what do you believe, right? You don't know if you
I'm going with that's a negotiating ploy, yes.
Right. So anyhow, point one from Treasury Secretary Scott Bessent is definitely using it as a negotiating tool to dictate terms for trade. Then here's a quote from Commerce Secretary Howard Lutnick. He says, quote, when you're running for office, you make broad statements so that people will understand you. Tariffs are an amazing tool for President Trump to use. And he understands, this is Trump's quote, don't tariff stuff we don't make. Trump said that. And build in America. We can't, this is interesting, Mark. He quotes this. We can't sell a Ford or General Motor car in Europe because there are 100% tariffs. Mark, did you know that?
I did not know that, no.
100% tariffs. Now, here I am in the middle of a quote from Commerce Secretary Howard Lutnick. But if I was running the country, I would have trade rules where as you do unto us, we will do unto you. If those rules were in place, I think that would change how a lot of trade is done with the United States. But anyhow, continuing with Commerce Secretary Howard Lutnick's quote on tariffs, he makes this point: we can't sell a Ford or General Motor car in Europe because there are 100% tariffs. He continues, in Japan, also 100% tariffs stemming from, this goes way back to the Marshall Plan. How about we say we're going to tariff you like you tariff us, tit for tat? Of course, they're going to come in and negotiate, and tariffs are going to come down. So trading levels are expected to come down and more fairly level the playing field is the point for Commerce Secretary Howard Lutnick. Here is a quote from U.S. Trade Representative Jamieson Greer. He says this, quote, tariffs can help support U.S. manufacturing jobs in particular, especially to the extent that they're remediating an unfair trade practice. If you level out that playing field, it makes it so Americans don't have to compete unfairly. So, for example, I don't know, there's probably much better examples, but Boeing makes our jets in a market that's unsubsidized here, but the competitor Airbus in Europe is heavily subsidized. So I just wonder, again, this is a quote from U.S. Trade Representative Jamieson Greer, how much of that is to level the playing field for trade and how much is just negotiating or both. Here's another point from National Economic Council Chair Kevin Hassett. He says, quote, if you look at the Republican platform, the first listed trade policy is the Reciprocal Trade Act, which takes U.S. tariffs to levels that our trading partners charge us. What happens to inflation? By the way, inflation is the key number one concern for the whole tariff conversation with Trump. So Council Chair Kevin Hassett continues, well, what's the next best supplier? He explains, what's the cost ratio between them? And if we bring new stuff into the United States, what's the marginal effect of the marginal cost? Don't forget that the tariff affects the price level when it goes in, not the long run inflation rate. Basically, it's a level adjustment. And one of these quotes that we'll come to, Mark, is the effect that Trump had on using tariffs 2016 to 2020. There wasn't an inflationary effect when he used tariffs then. And so one of these quotes that we'll read makes the point that that concern, which is huge for people investing and the markets right now came into 2025 with the expectation of 4 rate cuts. Well, the jobs numbers are coming in hot. Wages are not going down. Inflation is still staying stubbornly above 3%. So we've gone from 4 rate cut expectations to now we're down to 2, totaling about 50 basis points, 25 bips each. So the markets have started to come down. That's why the rest of today's discussion will be about retirement portfolios and how to do well in up, down, or flat markets. We'll get to that in a second. Here's another quote. I've got last 2 here. Chairman of Council Economic Advisors, Stephen Mirren, he says this, quote, in the real world, we have a one-sided free trade policy in which America isn't nearly as protectionist as other countries. Trump's proposed tariffs could generate some $450 billion in revenue a year for the United States. Isn't it better to tax foreign entities for entering the American market than impose new taxes on American families? That's a great point. He continues, we also need targeted tariffs to lift such critical industries as defense. The U.S. relies heavily on imports to make weapons and other material our military needs. This doesn't make sense, unquote. Here's the last quote from Peter Navarro. He's White House senior trade counselor. He says this, quote, we put on significant tariffs on China, steel, aluminum, dishwashers, solar, a lot of increased countervailing duties to stop the dumping in Trump's first administration. We had zero inflation from any of that. It never happened. And it's the same movie this time. Inflation is a monetary phenomenon where we run a Federal Reserve that prints too much money, and they do that to accommodate fiscal irresponsibility. So he makes the point, Peter Navarro, that with the tariffs being used as a negotiating tactic, or in fact, something that does go in place to level the trading field, that didn't produce inflation 2016 to 2020 shouldn't before. By the way, Trump makes a lot of statements. He said this, that caught my attention. He said that he could pay for America's expenses by tariffs. That's a head scratcher. Mark, do you think that he can do that? Do you think that
Well, your number was 400 and some billion, and our expenses are well into the trillions. So I think we spend 6 trillion, bring in 4 trillion is kind of the deal. So we're 2 trillion shy. So if he bring in 2 trillion, I guess then it would make sense.
Or maybe you could take a hit on that deficit that's run 2 to 3 trillion in deficit each year.
Yeah.
Maybe between that and Doge, we can close the deficit each year. That's probably about it. But that'd be a good thing. I'm not saying that's bad. But wanted to cover this right at the top of the show, Mark, because the tariffs are an uncertainty that the markets are digesting right now. And being inflationary is something that the markets don't know. Market uncertainty is not good. Markets go down with uncertainty and level out and start to go up when the clouds of uncertainty go and dissipate.
And I think the tariffs that Trump did in his first term as president, 2016 to 2020, Biden left a lot of those tariffs in place. He did not remove them. He kept them in place. So that meant both parties thought they were good ideas, I would say. You'd buy that, wouldn't you? Yeah. All right. So how does that affect, I guess, our economy, the tariffs? One way it can bring money in. And then the other thing that Trump has talked about is the corporate tax rate, where in the 2017 Tax Cuts and Jobs Act, he had the end date for us, for families and individuals, the tax rates, sunset at the end of 2025. But the corporate tax, he lowered it from 35 down to 21%. He's talked about taking that from 21 down to 15. If they raise corporate taxes, they typically make us pay more. So I'm okay with that. How do you see that? Does that kind of play into this tariff world where there's an opportunity here for businesses maybe?
Oh my gosh, the market would take a huge move up if 15% corporate tax rates would be in place. If the markets believe that, I know he says a bunch of things, but if the markets believe that 15% corporate tax rates were a reality, markets would go up very, very quickly. Right now, it appears that markets don't believe that 15% can possibly get passed through Congress.
If you have any questions about where you are on that road to retirement, does this affect me and my family? How does this all affect me? Because we don't want our retirement based on Washington and Wall Street, but we know Washington and Wall Street play a part in it. So we need somebody to keep track of it. That's what Brian and the team at Decker Retirement will do for us. 833-707-3030 if you'd like to chat with Brian and the team. No cost for this. 833-707-3030. We're going to come back. We're going to talk about, how do we succeed in an up market? That's fairly simple. How do we succeed in a down market? A little more challenging. How do we succeed in a flat market? What about that one? Brian's going to talk about all of that when we come back on Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Back right after this.
The holidays often remind us how expensive life can be. If you're feeling a bit more financially squeezed this season and worry about how you'll fare in retirement, give Brian a call at 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, DeckerRetirementPlanning.com to learn more. Find out all those things you can download. There's 12 things you download under the heading of Safer Retirement Education on that website, including Brian's book on retirement, the Decker Approach book. A lot of information there on the website. Check it out, DeckerRetirementPlanning.com. If you have questions, concerns, you can always call Brian and the team. No cost to do so. 833-707-3030. 833-707-3030. All right, you spend a lot of time talking about markets and investments, and you don't have all your clients' money sitting in the Wall Street world. You guys, typically might be 70% of their money is safe, 30% of it's at risk, growing and all that. So everybody's situation is unique. That was just a kind of a general lay of the land. But there are challenges for us when the markets go up, everything's pretty easy. When the markets go down, like the Great Recession, 07 to early 09, or the dot-com bubble bursting, or COVID hits and it goes 35% down in a month, 5 weeks, I think it was, there are certainly some challenges in a down market. But I think the numbers you always throw out when you do that every 13 years or whatever it is, 14 years, where the market's done a flat time period, that we're kind of in that area right now of a flat market. So you're going to talk about in the next two segments how to be successful with your investments in an up market, a down market, and a flat market. They're all different, aren't they?
That's right. That's the rest of the show. So there's two great quotes from Warren Buffett. One, he says, don't confuse brilliance with an uptrending market. And then he says, it's when the tide goes out that you can see who's swimming naked. In other words, who doesn't have a plan, who gets ravaged in a down market. So in retirement, the very strategies that bring you to retirement are the very strategies that will hurt you in retirement. So, for example, accumulation strategies are what banks and brokerages, that's what they specialize in doing. The pie chart, indexing, bond funds, buy and hold, all of that is accumulation strategies. That's what brings you to retirement. In your 20s, 30s, 40s, 50s, every 2 weeks, you add to your 401k. Markets go down 30, 40, 50%, no big deal. Your income is coming from work, so that's fine. And every 2 weeks, you contribute to your 401k. So you have the time, the 3 to 5 years for the markets to recover, and you actually are better off. Now let's use the same strategy. You're 65, retired, your portfolio is down 30, 40, 50%, but this time, instead of adding to it, now you're in your retirement years and you're pulling income from it. That is lethal. That will send you back to work. If you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down, and that will send you back to work. Those are accumulation strategies. Now, let's take these in three parts. So every retirement portfolio has three parts: cash, safe money, and risk. On the cash part of your portfolio, we just hope that you do your homework and make sure you don't put your cash part of your portfolio in the bank, earning under 1%, especially when there's portfolios out there that are earning well over 4% that are principal guaranteed. So we hope that you do your homework and make sure that the cash portion of your portfolio is earning a good return. However, how do you know how much to put in in the cash portion of your portfolio? You can't know that unless you have a distribution plan. A distribution plan takes a look at your age. We plan out to age 100. And we include all of your income sources. So for example, Social Security for you and your spouse if you're married. We include any pensions. We include rental real estate. And then we include portfolio income from your assets. We total those up minus taxes, and we put a COLA, cost of living adjustment, on that plan. And we have you living to age 100, not because we think you'll live that long, but we want to make sure that your money outlives you. That is called a distribution plan. That is something that is updated every year. And that is something that allows you to know with very high confidence how much money you can draw each month. The number one fear in the United States for people over 60 is running out of money before you die. And the reason is because bankers and brokers will tell you that your retirement plan is a pie chart when it is not. No person can look at a pie chart and see how much money you can draw from your portfolio. When it comes to distribution planning, we make sure that you can see how much money you can draw. Our clients don't have that number one fear of running out of money before you die because they can see with very high confidence how much money they can draw each month. Every year we reset it and they put the COLA in place and they're able to make more money each year to keep up with inflation. So the cash portion of their portfolio is calculated for them in the distribution plan. We're a math-based firm, so of course you would expect nothing less than a spreadsheet, which is what it is. Now, when it comes to safe money and distribution, the offset or the plan that's used by banks and brokers is called the 4% rule. William Bengen is the creator of the 4% rule. In the mid to late 90s, he noticed that the stock market had averaged around 8.5%. Bonds have averaged around 4.5%. So he said, if you draw 4% from your portfolio, then you will be fine. Well, it's true as long as you're in an uptrending market. What his mistake was is he assumed that markets trend higher when they do not. They do not. They have cycles. So for example, in the last 120 plus years, markets have cycled. Every time the stock market has moved to a market valuation of over 30 times trailing earnings, there has been a digestion period of 17, 18 years. 1929, there was 17 years where the markets went nowhere. 1964, there was 18 years of flat markets. 1999, November of 99, 14 years of flat markets, where markets went up, down, and went nowhere. Well, we hit 32 times trailing earnings in November of 2021. And that means, ladies and gentlemen, that if you have a buy and hold strategy, buying and holding stocks, mutual funds, indexes, or ETFs with 100% certainty from historicals, we're looking at the next 10 to 15 years where markets go nowhere. Now, that's devastating in retirement. So the 4% rule does not work in a flat market cycle. William Bengen admitted that in 2009. So imagine, Mark, you have $2 million and you retire January 1 of 2000. That's the good news. The bad news is markets start a flat market. So 2000, 01, and 02, the S&P is down 50%, but you're down more than that because you drew 4, 4, and 4. You're down 62%. Markets go up and double from there, but you don't get all that over the next 5 years because you're drawing 4, 4, 4, 4, and 4. And then you take the hit of 2008 and where markets bottomed in March of 09, and now you realize you can no longer stay retired. You've been decimated by a flat market cycle. So this is something where millions of people with gray hair showed up, banks, fast food, Walmart. They couldn't stay retired, so they came back to work. The 4% rule, according to William Bengen, who created it, does not work in a flat market cycle. He pointed that out, like we needed to know that. Millions of people had their retirement plan decimated by using the 4% rule in a flat market. We are warning you now not to use the 4% rule because the same valuation levels have been hit. And with 100% history, we're looking at the same. So hopefully you use a distribution plan, which is what we use. The pie chart is not a retirement plan. And the other thing I want to get to is when it comes to interest rate risk and bond funds. Interest rate risk is what you lose in your bond funds when interest rates go higher. So for example, the 10-year treasury was at 2% in 1940. 40 years, it went to 1980, it was almost 15%. From 1980, 40 years of declining interest rates. In August of 2020, we had 0.47 for the 10-year treasury, almost at zero. Whoever was recommending bond funds at almost zero rates was a fool. And that is financial malpractice, Mark, to be recommending people in retirement to have bond fund exposure at that time. But most bankers and brokers continue to do it because, quote, that's what we've always done. Well, in the last 4 years, most people with bond funds have lost over 30%. We have started a higher interest rate cycle. Now, September of last year, 2024, is when the Fed started to raise rates. September of 2024, the Fed started lowering rates. What happened to the 10-year Treasury yield? Did it go down? No, it went up. The reason it went up is because we have a $36 trillion deficit, and these bond auctions are failing to move that kind of volume with lower rates. And so we expect interest rates to continue to trend higher. Whoever owned bond funds in a rising interest rates environment will lose money. There's a better way, which we'll talk about on the other side of the break.
833-707-3030. If you have questions about any of this, or you have questions about, hey, I think I can retire. I hope I can retire. I wonder if I could retire. But you don't really know the answer to those questions, talk with the team at Decker Retirement Planning. That's what they're all about, helping people figure out where they are, what's their situation, how much income you need, where's it going to come from, what about your investments, are you invested the right way, what about health care, what about taxes, what about estate planning, all that kind of stuff. Social Security, Medicare decisions, a lot on your shoulders. Brian and the team at Decker Retirement here to help. 833-707-3030. Again, complimentary, no cost to you, 833-707-3030. Back with more, and especially delve into the interest rate thing. It's kind of a weird dichotomy. Brian will explain when we come back right here on Safer Retirement Radio.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, you can always check out, learn more on the website, find out our upcoming events in your area, deckerretirementplanning.com. Find out where the offices are. We've got offices all over the place. Really to help you figure out where you are on that road to retirement. Can I retire? Do I have enough? Are we going to be okay? Will our money last? 833-707-3030 is the number. No cost, no obligation, no pressure, no judgment. 833-707-3030. Well, I don't know why you wouldn't take advantage of this. At least get some insight into your situation. 833-707-3030. I'm Mark Elliott. Glad you're with us. You're talking about interest rate risk is what you're going to delve into in this segment. And you were talking about one of the weird things, I think, the Federal Reserve Chair, Jerome Powell, they were talking about going into 2024 that they were going to lower the interest rates probably 4 to 6 times. Well, they did it twice because inflation stayed up a little bit, but they dropped it 0.25%, I think in September and November or September and December, something like that. They did it twice. But the weird thing is the interest rate level for the mortgages, for cars, for the Treasury, those interest rates were going up while the Fed's trying to lower. How does that work?
It is pure supply and demand. When the demand for treasuries go down, the way you level supply and demand is to make it more enticing. And so you raise the yield. So we have such a huge amount of supply that you've had to lower the price, raise the yield in order to move all that. And when it comes to mortgages, the amount of mortgages, again, it's supply and demand, the amount of homes for sale. The supply has gone way down. The demand has gone up. So banks are able to raise the mortgage rate to level out supply and demand on the home mortgages. So it's interesting that that's how it works. On this segment, I want to talk about options that are available for people so that they can, on their safe money, make money in up or down markets. So Mark, let's say that interest rates are going higher. If interest rates are going higher, you buy a CD, you wish 2 or 3 years later that you didn't buy it because the rates are much higher. So we use laddering. We buy for bucket 1, we put cash accounts in place. Bucket 2 is a 3-year CD. Bucket 3 is a 5-year CD, or bucket 4 is a 7-year account, and bucket 5 is a 10-year account. We ladder in principal guaranteed accounts. We are making sure that we don't have interest rate risks. So none of these are bond funds, which lose money as interest rates go up. But what we do is we find the best performing money markets for bucket 1, which right now is about 4.3%, what we get at Fidelity. Then we look for the best performing CDs. And by that, we use the WINK, W-I-N-K, the WINK database that lets us see all the offerings from banks and insurance companies. And Mark, most people don't know this, but most of the time, we get a better rate from insurance companies on guaranteed fixed rates than we do from the banks.
So like a fixed annuity type thing, which is similar, which is the insurance company, I guess, semblance of a CD at the bank.
Right. If we have a guaranteed rate, we just look and find the best rates for A-rated or better on the insurance companies and, of course, FDIC on the banks. The thing that we don't have to worry about with insurance companies is the $250,000 limit for insurance that FDIC puts in place. But anyhow, we put in place buckets 1, 2, and 3 are fixed rate accounts. Here's why that's important. If markets go up, then we participate. If markets go down, we participate. If markets are flat, we participate. Those are going to make money no matter what. So buckets 1, 2, and 3 are very important. Those are steady Eddie, guaranteed money coming into the portfolio. No matter what interest rates, stock markets, economies do, those are fixed rate investments. That's very, very important to our retired clients. Then we have 7 and 10-year principal guaranteed accounts. Where are we getting the best rates there with no interest rate risk? We used equity indexed accounts. Equity indexed accounts. By the way, we will never use variable annuities, income annuities, life annuities, or income riders. That's a whole nother show to tell you why, but just make that statement. We will never, at Decker Retirement, we will never use variable annuities, income annuities, life annuities, or income riders for many reasons.
I like income annuities. I want a pension. I want to create my own pension. So I'm going to do an income annuity. You're against it.
Oh, right. So I'll take a minute on this. So Mark, let's say you're 65 years old.
I am 65. Thank you.
Okay. You're 65 years old. You put $100,000 in an income annuity. That guarantees you for 10 years a 7% rate. Fantastic. So in 10 years, your 100,000 doubles to 200,000. Now you're 75 years old and you get paid 4% for life. So 4% of 200,000 is 8,000 a year. How long does it take to get your original 100,000 back? 8,000 into
Sounds like I might have passed away by that time.
Is 12 and a half years. You go 22 and a half years without making a dime. Those are called income annuities or life annuities or income riders. The 3 different names for the same thing. We don't like them. We don't use them. We warn people to stay away from those. But anyhow, equity indexed accounts are principal guaranteed accounts that invest in 3 different markets, and they allocate daily between stocks, bonds, and commodities. Why is that important? That's important because in 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%, but these equity indexed accounts allocated towards bonds and commodities that did well, they made very good money in 2000, 01, and 02 when the markets were creamed. Then in 2008, stocks and commodities were creamed, but bonds were up to 20%. So there are years when stocks, bonds, and commodities all go down. at the same time. It's happened about 5 times in the last 30 years. So there are years when you get a zero, but you can never lose money. And the average annual returns for the indexes that we use are about 2 times what the CD rates are. They're variable rate investments. However, they have no interest rate risk. And so we like them, we use them. And unlike a CD, we're able to draw income while the money is growing. We're able to use up to 10% per year, no penalty. Now, here's the last thing we love about equity indexed accounts. AI has changed everything. AI is an enhancement in the allocation between stocks, bonds, and commodities on a daily basis. They've changed it to hourly. And so the returns in the last 10 years that we're seeing for these AI equity indexed accounts in the last 10 years are averaging 12, 13, 15%. We use the no fee indexes. We use the indexes with no annual fees. We try to keep the fees at zero, and we have great success in using them. In the trailing 12 months, these are up. We just did an annual review for a client today. The 1-year accounts were up 12%, and the 2-year accounts, midpoints, were up over 20%. And these are on principal guaranteed accounts. And so these are very, very new. The AI indexes are very new, and we use them for retired clients. Some people don't know about these. We are fiduciaries to our clients. We do our homework. We're math-based, and we take that very seriously, and we do our homework to find the highest earning principal guaranteed accounts. So, Mark, when it comes to laddered principal guaranteed accounts, we are able to make money in up markets, flat markets, or down markets on the guaranteed side of the portfolio, because bucket 1, 2, and 3 are fixed, and the 7 and 10-year accounts are variable, but those accounts make money in most all markets.
Because what you're saying really is that to make money in the up, down, and flat markets, you're not talking about the money that's at risk. Because in a flat market, a down market, you're not really making money on the market. There are maybe sectors, though, that are doing well, I suppose. That's where you kind of move things around, I guess?
Well, when we say sectors, we're talking about commodity markets. We're talking about bond markets. We're talking about stock markets. So what's nice about the equity indexed accounts is they're able to invest in those and allocate in those on a daily basis to find which markets are trending higher that day and do very well for principal guaranteed clients.
Yeah, because you use the trend models that are, and you have what, 6 different managers type things that you're following all this with?
Oh, that's on the risk side. It's risk money. Nothing is guaranteed, but they have a very good history in how they allocate and jump into whatever is trending higher, even in a down market.
So where you're talking about right now, the up, down, and flat markets is the protected side of the portfolio.
So part of the portfolio, the laddered principal guaranteed accounts produce income for the client's first 15 to 20 years. And the risk bucket grows for 15 to 20 years to replace or replenish the principal guaranteed account. So we de-risk the clients, we refill the client, and the risk bucket growing for 15 to 20 years is designed to replace what they started with. If the client starts with 1.5 to 3 million or 500,000, whatever it is, we peel off 25%, put it in risk, and have it grow for 15 to 20 years to replace that starting balance.
How far do you go out?
We go out 15 to 20 years. And on the risk managers, what's nice about momentum is they buy what is going up. In 2000, 01, and 02, when the markets got creamed.
I thought you're supposed to buy low and sell high.
No, they buy whatever is trending higher. In 2000, 01, and 02, those were trending markets in real estate, gold, silver, energy, pharmaceutical, biotech, healthcare. Those sectors and those stocks did very well, while the markets got crushed.
So as you can tell, if you're trying to do all of this yourself, well, I don't know what you're going to do in your spare time because you're not going to have much of it. That's where Brian and the team at Decker Retirement really come in to help you they have to get a feel for you, right? What risk level are you comfortable with? What kind of income do you need to maintain your lifestyle and all of that? Because it is about you, as Brian said, but everybody's situation is unique. And so that's the idea, to sit down with Brian and the team. Do you have a portion of your portfolio that is guaranteed to be safe no matter what happens in the market world? Do you have a part that's in there to grow? When the markets are good, you're taking advantage of it. But if the markets are down, you're not pulling money out of that cash flow that you would need when the markets are down. So this is really where Brian and the team, I think, really step up to really help you make the right decision for you and your family. 833-707-3030 again is the number. There's no cost. There's no obligation. There's no pressure. There's no judgment either. Brian still, he's with me for holding on to Blockbuster video stock. It's coming back. We know it. Nah, probably not. But there's a lot of decisions you have to make. Why not have a chief financial officer there to help guide you? That's what Brian and the team at Decker Retirement can be for you. 833-707-3030 again is the number. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us again. You can go to the website, DeckerRetirementPlanning.com. A lot of great information there. You can also go to the heading on that website of Safer Retirement Education. Download Brian's book on retirement if you want to, The Decker Approach. 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. Those are just 4 of the 12 things you can download on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. No cost to you. It's all there for your information. You want to learn more? Just go there and check it out. Take what you want. Download whatever you want. We're talking today really about where the markets are, where they're headed, but it's really about you and your portfolio. We don't want to run out of money before we run out of life. So the idea is, how do we set up our portfolio? Are we taking too much risk? Not enough risk? Do we have enough guaranteed income to not worry about what happens with the markets? Certainly during a flat time in the markets or even a downtime in the markets. So the question really that I'm going to pose to you for this final segment is, so you think about a lot of people like me. I don't really understand the financial world. I knew back in 2009 I should have spent that $1 to get me 100 Bitcoins, but I did not. And if I would have, I could be retired. What, 90,000, 95,000 a coin now or some crazy thing like that? And it was less than a penny for a coin back when they started. Nobody knew what it was. We still don't know for sure what it is. But you think about that buy and hold strategy. I'm putting my money into my 401k, just every paycheck, money goes in. I don't really know what it's doing because I don't understand it. That's where Brian and the team at Decker Retirement come in to help guide you. Once you get to 59.5, you can roll your 401k while you're still working. You keep contributing, taking advantage of the company match, but now you've got your portfolio a little bit more organized for you. And Brian and the team can certainly help you with that. But the question is, how do I transition from the buy and hold strategies of old, and how do I move that into this two-sided approach? How do we make that conversion?
Okay, there's pieces of your portfolio for tax strategies that allow us to move different pieces to the right spot. So for example, Your Roth money is growing tax-free. It distributes income back to you tax-free, and it passes to your beneficiaries tax-free. The spot for Roth money for us is the growth portfolio, the risk bucket. We are doing clients no favors by taking an IRA from 500,000 to 5 million. Now they have an account that they owe 5 million in tax on when they could have paid tax on 500,000. What we want to do is over 5 to 7 years, we want to convert IRA to Roth in the risk bucket, not in buckets 1, 2, 3, 4, or 5. Those are principal guaranteed accounts. You're taking income too soon. It is only in the risk bucket that we want to see Roth money or IRA money that we convert to Roth. So the Roth account for most people is the biggest tax saving strategy in their lifetimes that is left. And it needs to be used correctly. So for example, we're a math-based firm, and we know to the penny how much money should be converted from IRA to Roth. If you have a pie chart, you're guessing. You have no idea. If you have a distribution plan, which we use at Decker Retirement Planning, we know to the penny how much should be converted from IRA to Roth. So what we do each year is we look at the client's gross income, which our plan shows. It includes Social Security, pension, rental real estate, portfolio income. We gross it up. So that's part of a distribution plan, is showing all their sources of income. And then it allows us to take away use their standard deduction or itemization to come up with an AGI, adjusted gross income. Then we look at the tax tables and see how much room is there between where they are and their next tax bracket. That's what we call headroom. Now, we want to keep clients from going from 12% to 22. We want to keep clients from 24 to 32, ideally. Those are big bracket jumps. The difference between 22 and 24, not so much. But we want to minimize the tax bracket, get as much Roth conversion as possible, and keep them in the same tax bracket. So that's what we do each year. We do tax planning that way, and we convert IRA to Roth. Now, there's 36 trillion reasons why most people expect that tax rates are going to go higher. So how smart are we to proactively pay taxes now and have that money grow tax-free? So that's what we do on the risk bucket. Now, to convert a client from taking the pieces of their portfolio, there's typically 3 different parts to the portfolio. There's cash, safe money, and risk. We put the Roth money and the IRA that we're converting to Roth into the risk bucket. Now, the cash portion of their portfolio, which is bucket 1 and their emergency cash, obviously that's cash management. That's a combination of money market. We buy short-term CDs. We get 4.5% to 5% on that money right now, but we work that money. Then when it comes to buckets 2, 3, 4, and 5, those are 3-year, 5-year, 7 and 10-year principal guaranteed accounts. We sprinkle some qualified and non-qualified money through those buckets. Qualified money are IRAs, money that you haven't paid tax on yet. Why do we want to proactively pay taxes now? Well, there's 2 reasons. One is we want to minimize clients' required minimum distribution exposure. By the time they turn 74, we want to make sure that we've spent down as much as we can on their IRA. Why? Because we don't want required minimum distributions to be a big part of their lives in retirement. Also, we think that tax rates are going up, so we proactively pay taxes on that money now. Second, we sprinkle non-qualified money through those buckets. Non-qualified money, Mark, when you pull up to the bank and you take $1,000 out of checking or savings, you're not taxed on that money. That's already taxed money. That's called non-qualified money. So we sprinkle that through buckets 2, 3, 4, and 5. So yeah, you might be getting $150,000 from your portfolio, but the taxable amount is much less than that. So that's how we do tax planning. That's called placement, where we take each part of the portfolio and we sprinkle it through the portfolio. So when we get a client and we convert their portfolio, their pie chart portfolio, that's how we do and move the pieces to where they should be. That's the tax planning that placement allows us to do. And Mark, there's not just the Roth conversion that is the tax planning that we do. We work with client CPAs. We're not a CPA, can't give tax advice, but we do promote tax strategies. And I'm going to just run through a bunch of them that we work with clients. Let's say that we've got a client that exercises stock options that spikes their taxable income in a year. Well, we use a donor advised fund. And if they're charitably inclined and they give to their charity or their churches, we're able to take 5 years of charitable donations and bring it into 1 year as an offset to lower the taxes in that year. If a client has large capital gains and they're in their 60s or younger, we're able to use a charitable remainder unit trust to zero out the capital gain by transferring that to their favorite charity, charities, church, whatever, and sell the building, could be real estate, could be stock, in the name of the charity or the church. There's no capital gain. And then the rules of the CRUT, the Charitable Remainder Unit Trust, is that a minimum they have to take 5% of income each year from the CRUT. And the agreement is that at least 20% is left over for the charities. So what we do is when we transfer those funds over, we get a very, very large charitable deduction that we use to either offset income in the future, or we use to move a massive amount of IRA to Roth. But then we have a taxable income stream that comes back to our clients. And if this is done correctly, it's in the name of two people, husband and wife, and it spreads the income out over their lifetime. So if we put X outside of their estate, we're able to bring in 4 or 5X back into their estate, and they've paid no capital gains. So that's something that allows clients to avoid that capital gains. The third tax strategy that we use, if we see an age difference and a client has married a spouse that's 10 years younger and they have a 401k, we use the Quadro, Qualified Domestic Relations Order. There's an unhappy Quadro, Mark, where a judge divides your assets in a divorce. That's an unhappy Quadro. There's a happy Quadro where we can use the Qualified Domestic Relations Order to split that 401k and send half to the younger spouse and keep half. So that allows a longer runway to do Roth conversions. Another strategy, we have a lot of clients with exposure to state or federal estate taxes. Now, half our clients say, what do I care? I'm dead. Whatever Johnny gets is more than I ever got. And so I'm not going to worry about the state or federal estate taxes. The other half of our clients say, oh, no. After paying a lifetime of taxes, I would roll over in my grave if I knew the state or the feds took another $1.5 million just because I died. I'll make sure that doesn't happen. So they buy a second to die life insurance trust held outside of their estate. That's key. And those funds, you're able to pay about 20 cents on the dollar and have those funds settle up for your estimated estate taxes when you die. There's other strategies, Mark, that we don't have time to get into. I'll just hit one other one. For rental, people that own rental real estate, there's a way to use accelerated depreciation called cost segregation, where instead of 23, 27 years in depreciation, you use 10. Now your income stream is 100% tax-free. Every 10 years, you do a 1031 exchange, but that's a way for you to have rental real estate income stream be 100% tax-free.
So here's the deal. Brian covers a lot of ground every week on this program. Glad you were with us today. We'll do it again next week at the same time, same bat channel, all of that. But there's a lot going on. So the question is, do you know how your portfolio is doing? Do you know if it's set up the right way for what's ahead? Do you know if you're going to be good when it comes to retirement, that you don't have to worry about things? You're going to be able to do the things you've always dreamed of doing in retirement? Or are you one of those you're not really sure? I think we're going to be okay, but I don't know. Why wouldn't you find out? 833-707-3030 is the number to talk with Brian and the team at Decker Retirement Planning. 833-707-3030. Might be the most important phone call you make, and there's no cost. 833-707-3030. Brian, as always, enjoyed it. Enjoy the rest of the weekend. We'll do it again next week.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.